We've been gone the past few days. We're making today's video a little bit later than usual. I'm moving back to Texas this week. Might be not at the same time every day. I'll be here though. I'll be traveling to Texas. So, apologies for the inconsistency. However, what is remaining consistent, despite being objectively incorrect, is our view that the rally has been quite strong and it's time for some pullback. Simple as that. Not just the rally in stocks, but the rally in bonds as well. And we think there are fundamental reasons behind this. And we'll get into all of that, lay out the case, and express our overall market views and how we're positioning and adapting to the environment. So let's go over what's happened here. We've had roughly, we'll call it in the market, 20% run. I believe it's less than that, obviously in the S&P 500. But here's a thing that I learned and that I've seen. Stocks take the elevator on the way down and the stairs on the way up. And we're certainly taking the elevator here on the way up. At the current rate, the recovery of the market will be faster than the decline into the bear market. And I think that is quite a lot to ask. I think that's quite extreme. I think that's quite a lot to ask in a still highly inflationary environment. In an environment that has seen some pullback in oil prices, but come October, it's probably not going to be the case. However, we're probably going to see additional pressure there because we're going to enter the 2 months of the highest intensity strategic midterm reserves selling off, and then all of a sudden it's going to vanish. Come that election, it's going to vanish. So we'll see what happens there. Yields, okay? The Fed has talked very consistently and very clearly about their perspective on yields. And there's another phrase in the market, don't fight the Fed. I'm not breaking that rule. I don't see any reason to break that rule. I see a consumer, I get it, Walmart beat expectations, but they lowered profit forecasts. So they have lowered their forecast for the year. This is typically a stock that is way cheaper than it is now. It's at a roughly 28 PE, way too expensive for my liking right now. And they're saying consumers are trading down, and they're seeing a higher prevalence of middle and higher income consumers. I get it. People like Apple, it's almost back near all-time highs. It has a tremendous multiple, but it's not growing at the rate it was when it was at previous all-time highs. I thought it was too expensive at previous all-time highs. Maybe they grow the revenue in the 10-year period, but in an uncertain economic environment that I think is going to continue to get worse. The Fed has said it's going to get worse. I'm hesitant. So I'm just taking a breath. I'm sitting on the sidelines with some cash. I've got some hedges. I've got some longs, way less than I did maybe 2 weeks ago. Way less than I did 1 week ago. I mean, I've just been selling into this strength. You know, before people would say sell into strength, I'd be like, what are you talking about? Just sell into strength, we get a little bit of a pullback and then we're higher. Why would I sell into strength? Now I'm expecting a deeper pullback, a longer pullback, a longer return to the current levels, and I'm now understanding what sell into strength means. So I'm selling into strength. I just think that's the appropriate thing. You know, we're quite expensive. I don't want to buy. The economic environment's not the same. Rates are higher. It's like we're right about where we should be, I believe. You know, I'm kind of guesstimating here. I don't know what the exact number is or the exact calculation that you would use for this. But given that the 10-year went from less than 1% to, we'll call it 3%, because it's going to get there any minute now. It should be higher than 3%. I mean, the market should be here. The economy's doing nothing if it's just as good. And I get it. There's signs that it's doing all right, but I'm not convinced those signs are going to hold. I mean, we're seeing a massive increase in consumer credit use. When does that credit line end? Productivity's down. There's just a whole bunch of metrics that don't sit right. I get the bull case, but after this run, I'm leaning more towards the pullback case. You know? So, that's today's video. We'll see what happens tomorrow. Until then, peace out.